Hello, ladies and gentlemen. My name is Chris Leyland, and I'm the investment director who heads up the True Potential portfolio proposition. And let's talk a little bit about the portfolios and how we manage them in respect of Brexit. Look, Brexit's a challenge for all concerned, and the overall outcome is unknown, and it's sufficiently opaque that it will be unwise to try and place a trade around Brexit. What can be looked at is the facts. After the initial referendum, sterling devalued significantly, and whenever a Brexit deal looks less likely, we've seen sterling falling. Any positive or negative news plays mainly through the currency markets. For the True Potential portfolios, our 9 managers all have different ways of tackling currency risk, using hedging at different levels or currency overlays to help mitigate overall currency risk. The beauty of the portfolios with their style diversification is that we're positioned for arguably either a soft or a hard Brexit. As the Brexit situation becomes clearer, we have the ability to add to the manager's styles that we feel will be most beneficial. Outside of currency, and this is really important, diversification is paramount, particularly within an uncertain political environment. Being invested worldwide, not just in the UK and Europe, and also being invested in a myriad of assets, all designed to be lowly correlated to each other, thus offers solutions for every type of Brexit scenario. Next, a question I'm being asked is, should I move to cash? I want to be very clear on this. The way to make good long-term returns within investment is to stay invested, to compound up growth. It's not always going to be comfortable, but by letting emotion come first, you run the risk of selling at the worst possible time, crystallizing negative performance, and not being able to make that performance up. Over the longer term, equity markets have always trended upwards. And I think secondly, in an era of low interest rates, the only real way to make a decent return is to embrace risk and be invested. The days of cash in the bank offering rates of 5% are long gone, and the likelihood of interest rates climbing back up to historical levels is remote. With inflation at over 2%, cash returns significantly lower than that. Inflation is eroding away returns for cash investors.